Well, it has been a volatile few weeks on the market, something investors really haven't been used to in the past little while. So to help us explain what has happened and more importantly where it's going and what he likes in this market, we're joined by Michael O'Brien. He is portfolio manager of the Canadian Equity Fund and managing director at TD Asset Management. Thanks so much for joining us today.
Glad to be here.
We have a lot to talk about. I mean, to say that it's been a busy few weeks is the biggest understatement out there. Let's just set the table, if we could, for what's happening right now before we move to 2015. But let's talk about oil. Oil has halved, basically. How does that change what you do?
Well, I think when you think about the oil price, it's where is it going to settle? Where is it going to go from here?
Yeah.
But then there's also another layer to it, which is what are the broader implications? Because oil is really the thing that makes the global economy go around. So in terms of where I think this is heading, I fully expect that oil will ultimately go higher. I think where we're trading today below $60 is unsustainable.
We've overshot?
I think we've clearly overshot in the short term. But with OPEC standing aside and letting the market sort this out, it could be 6 months, it could be 9 months, it could be 18 months before we really get back to that, what I would call more normal long-term price. So I think the first message for oil is we've got to be ready for a bit of a bumpy ride and show some patience. And so we got to distinguish between where the commodity is and where the stock prices are going to be.
Right, and I guess for you, it's also which companies have the fortitude, the balance sheet strength to withstand this 18 months right now, which is tricky.
Yeah, because everybody can see the promised land, but you want the people that can actually live long enough to get there.
Yeah.
So I think what you want to do is you want to focus on those real high-quality companies, place a big emphasis on strong balance sheets, so that you don't have to worry if it stretches into 18 months instead of 6 months. They're still going to be okay. It's the ones that don't make it from that 6 months to 18 months, you want to avoid those for now.
Okay, we're going to get to some names in just a few minutes on specifics on that. So oil is happening, the Fed. The Fed came out, we lost considerable time, we got the word patient back in. It was interesting that when you actually look at their forecast, I think from previous statements, actually not much has changed, but the market seems quite thrilled with what they had to say. So what did the Fed say from your perspective? Yeah,
well, I think what the Fed really said was two things. First, they're still shooting for June.
Right.
They're shooting for next June as the start for the process. But I think, and that in and of itself would not be a wildly bullish event in the eyes of the market. It's the market that's been trained to thrive on liquidity. But I think they counteracted that a bit by emphasizing the data dependency of it or the conditionality of it. In other words, they're not being dogmatic. They're going to be very pragmatic about the situation. And if it looks like things are going to, evolve a little bit slower, they'll take a little bit more time. So,
right. So if inflation doesn't come up or jobs aren't there.
So the way I kind of look at it, June is what they're shooting for. Could be as early as March, as late as September, but that's kind of what we're looking for.
Okay, and let me throw in from a political standpoint, Russia. I mean, we've got sanctions they're dealing with oil prices, perhaps some internal political unrest. We had Putin, of course, out taking questions in front of an audience yesterday, trying, I think, to just be open and talk about what's going on. But how does that impact, not so much just from a Russian standpoint, from a market standpoint? Are there ripple effects we need to worry about?
Yeah, well, I mean, I think I was talking to you earlier about this. One of my very first memories from joining TD Asset Management in 1997, if anybody remembers the summer of 1997, it was about 2 weeks after the Thai baht had just been devalued. And I remember distinctly at that time people saying, oh, not a big deal, that Thailand's a very small economy, it's not really interconnected with all these other ones, don't worry about it.
Yeah.
And of course that snowballed into the Asian crisis and long-term capital management and the Russian default.
Right.
So ever since then, I've always been a little bit careful when people try to explain away the significance of these events. I think what the Russian situation is, it doesn't have to end in tears for the broader system. It's a very difficult situation the Russians find themselves in. But it just adds an element of caution as we're approaching 2015. I think in-house, the way we've been thinking about how 2015 is shaping up is, we should expect more moderate returns than we've experienced in the last 4 or 5 years and a higher dose of volatility. So not the ideal cocktail, but I think that realistically, that's what we should be considering. And Russia is just one of those things that injects a little bit of caution into how we approach 2015.
Okay, as I was telling people, we will get some names in terms of equities, but just set the table then for 2015. That's what happened 2014. Russia's in the mix. What else are you watching in terms of which will inform the general sentiment on the markets?
Well, I think the single biggest thing is going to be the pace that the U.S. raises interest rates, the way the Federal Reserve handles monetary policy.
Right.
As some astounding statistics that I came across the other day, somebody was saying apparently 83% of the global equity market cap is being supported by zero interest rate policies today. US, Europe, Japan, and over 50% of all the government bonds outstanding across the planet yield less than 1%. So from a liquidity standpoint, this is about as good as it gets. So going to 2015, it'll be at what pace does that liquidity get tightened up a little bit, and is there enough momentum within the North American economy that we can grow through that and absorb the the normalization in rates?
But there's a liquidity coming from elsewhere at the same
Absolutely,
time.
and that's one of the things that's keeping people optimistic as we head into year end. When you look at Europe, people are expecting the ECB to finally move towards more quantitative easing in sometime in the first quarter. Japan clearly has the floodgates open there. So still, we're not talking about a significant tightening, but it's just a bit of a change in terms of what we got used to over the last 4 or 5 years.
Okay, in that environment then, for someone who's watching, some names that you like that you hold, and I'm assuming that you're continuing to hold in this environment, one is Suncor.
Suncor, yeah. Well, I think broadly speaking, the energy space has been really oversold. And so when you think about it, if you think long-term oil price is $80 to $100, would you rather be buying an oil stock when it's 115 going to 80 to 90, or when it's at $58 going to 80 or 90? I think, as we talked about earlier, as long as the company is strong enough to see through a few months, it's going to live to see much better days. And I think Suncor is clearly in that camp, rock solid company. And so this is the type of name I think you want to look for these opportunities as a long-term investor.
Let me ask you as well, one name that was actually in the news recently is Alimentation Couche-Tard. They're ones, of course, that I would think that would benefit from lower oil prices in some senses, that people be spending more at convenience stores. They just had a big buy in the States. I think they bought 1,500 new stores. This is one you hold as well.
Yeah, good day to talk about it. They're up 7.5% when I came in here. So there you go. But this is a great example of, when you talk about oil prices, your perception of it depends on where you're standing. And if you're standing in Alberta or Newfoundland, it might not look so great today. But names like Couche-Tard, they benefit from the weaker, they benefit from the weaker oil price. They benefit from their large portion of their business, which comes from the U.S., gets paid in U.S. dollars. This is the type of company that should do very well with a strengthening North American economy, a strong U.S. dollar, and low gas prices.
Finally, what about the financial space? We've seen a big sell-off in Canadian financials because of everything that's been happening in the oil sector and exposure, credit exposure, what have you, to the energy side. Anyone you like?
Yeah, I think the space in general looks very good from a risk-reward perspective.
Yeah.
I think it's a place we want to maintain a very healthy exposure to going into 2015. I've talked lots about the banks in the past. I think today I'd single out the insurers, and Manulife in particular is very well positioned, especially if you get that inflection from interest rates constantly just grinding down to maybe beginning to grind a little bit higher. An insurer like Manulife is well positioned for that environment.
Michael, such a pleasure. Thanks so much.
Oh, thank you.
Michael O'Brien, he's Portfolio Manager of the TD Canadian Equity Fund and Managing Director at TD Asset Management. I'm Kim Parley. Thanks so much for watching.